Okay, while still waiting for the setup to materialize, if we wanted to look at a proper setup, okay, let's look at history thereabouts to get a full picture. So now, since we already know that gold is bearish on this side, so as you can see, this is actually the current zone. We are still trying to get to this point. But before we even got to that point, before we make this low here, what happened here? All right, we saw how price dropped, created the fair value gap. You could see your valid order block there. That valid order block, which is this one. Okay, like I said, sometimes price doesn't get to order block. Sometimes it only gets to your FVG. Okay, it only gets to your FVG, which is this. So I can remove it. What I did is that FVG, because it's kind of wide, even if it's not wide, it's also good for you to draw your fib on it. Okay, so you can see what happened. But price tested the fair value gap a little bit, but it didn't get into the premium zone. All right, sorry, this premium zone is supposed to be drawn from the top to the bottom. Okay, so that's what happened here. So now in this case, price tapped into this fair value gap, but it didn't get to the premium zone. So if it didn't get to the premium zone, what do you do is that even if you go to a lower time frame, all right, you have to wait for a new formation. A new formation in this sense would be like this. Okay, since it didn't get to since it didn't, so what we are seeing is what we see: a clear of liquidity and a drop. When you see a clear of liquidity and a drop, you see new fair value gap. This one is also huge. So wait for price to come around here. Okay, but price did not. Price didn't. Kept dropping. So by the time we break this low, this one is already invalidated. It's no longer valid. So you have to wait for a new one to be created, which is why it doesn't even make sense. So anytime market did not come close, doesn't touch this line or within this zone, it's meaningless because you will not have confidence to trade with it. So that's pretty much it. So it's just better for you to avoid it. Yes, most times markets will leave you behind, but it's better for you to find yourself in a market you at least you have a plan for, not the one you don't have a plan for. But if you understand how to take trades like that as tap and go, then fine. But those ones that get to this line, they make it easy for you to take a trade. Okay. Now, if we're looking at this guy did not actually touch this line, the optimal point line. And yeah, he didn't. He didn't get to the within this zone. It's just around here, which means he didn't even get to 50%. Now, rules being rule, you are still gonna ignore it. Okay, you're still going to watch. Ignore it. Why? It didn't get to your zone. But there's something I would have done out of experience because I already had this guy here, and this guy has dipped a little bit without even giving me a noticeable entry. So now I've tried to, for some good reason, I would have, all right, be using this high as a reference. Why? Because price has created an engineered liquidity. So I will be using this as a reference. So when price, the first time price came, all right, would have called this a sweep of the liquidity, all right? So what now validates it? Once this sweep happened and we have a break, because this guy had dipped before and this guy came for the second time and swept it, once there's a validation of that sweep, which is price breaking below this guy here, all right? Price breaking below this guy here. Mind you, The reason is because liquidity has been engineered. So this first one that tapped into it, at that time there was no liquidity that was engineered. So I would have ignored it. Is there's no argument. But the second time it comes in, because there was already an engineered liquidity. Liquidity engineered simply means where there is money, order, all right, that could have moved price, because it's money that moves the market. So because I'm seeing this as a liquidity, that's why I'll now be interested in this second tap. Even though it didn't get to this point, that's why this one is kind of advanced though. So, but to keep things simple, you can always wait for this. But yes, 50 to 60% of the time you will miss out of the move. All right. But if you are a bit advanced, you always ignore this first one if it didn't get this to this point, especially when the fair value gap is large. All right. Because sometimes it's not worth it. But if you can maneuver, fine. Mhm. But yeah, if you can maneuver, there's a way. There's a way, even if I wanted to look at it, I would want another liquidity to be engineered and then price come back for it. You see, all these things are, it's kind of advanced and it will mess up with your head. Simplicity is just the best. Are you with me now? Simplicity just says wait for it to get to between 50 to 60, is it 68 points, 62 point something, is it 62 point something? I've forgotten the exact fib level, but yeah, if you want to check it, I think we can check it right here. It's taking a little bit of time. Okay, what I did was 71. Okay, 71. I'm not using 62, but the most important is getting to this green line because that's the 50% zone. Okay. So now, why am I considering this guy this time around? This time around, it was not validated, so there was no trade because we didn't sweep any low, we didn't break any low, there was no proper shift of structure. Okay. Now, for the second time, what happened? It actually swept it properly. Okay, and then there's a huge displacement. Once there's a huge displacement, you can see, okay, that low was now taken out. The moment the low is taken out, what did I say again? This fair value gap is quite huge. So from here to here, actually, can you see now this time around? Can you see price had gotten to this zone? So because this is the second time, you don't need to wait for it to refine anymore. But if you want to refine to a lower time frame, fine and good, but you can actually take it from here. Just place your pending order here. Okay. Just place your pending order here. Your stop loss being here. Okay, your first target should be around here. You can target here, all right, or just take a 1 to 3 weeks to reward. Okay, so that would be what it's supposed to be. But then, if you want more refinement, depending on how comfortable you are with the market and price, if you want more refinement, what you are supposed to down do is that you are going to go down to 15 minutes or 5 minutes time frame. This time around, with the structure I'm seeing, I'm go to 5 minutes because that's where I will see price open better. Okay, for the 5 minutes time frame, what we are going to be looking at, yeah, 5 minutes, 5 minutes. Okay, yeah, I'm almost, I'm on a free plan. So, yep, on the 5 minutes time frame, if you wanted to, okay, it's even a bit rough here on the 5 minutes time frame, but I've actually seen something. 5 minutes time frame is a bit rough, but it gave something, but it doesn't look right. 5 minutes does not look nice. So we check 15 minutes time frame. On 15 minutes time frame, how is it looking? What's price like? On this 15 minutes time frame, this first one I won't enter. I know this setup. That's one thing about trading like this. I know this kind of setup. It's something I would even avoid. You can't see, but price respected it, right? But I would have avoided it. I won't even take it because I know it's not reliable. I can't explain it, but that pattern is not something I like to trade. It's not reliable. It's not a reliable kind of shift. So where would I have entered? I would have entered with this guy. That's what I would have done. But price didn't come to that guy. You see? So I don't you do not refine more than twice. First refinement from daily time frame, second refinement, hourly time frame. Then if daily time frame is not your first refinement, if hourly time frame is your first refinement, then 15 minutes will be your next refinement. So just two times. So that's why that hourly entry would have been my entry. So this one would be trying to get another additional headache to your head. But right now, this one did not go. Even though this one would have given you a faster trade, but price didn't come for it. And there's one thing, there's how I know that price will most likely not come a for a zone. Look at it. I'm just giving some things that I'm not supposed to. So look at what happens here. It's if you have a fair value gap, you have this fair value gap, right? This fair value gap is existing here. But inside this fair value gap, this breaker or key level, or what do you call it? You call it breaker block, right? Or mitigation block. Is not existing within. Price had already mitigated it. So this fair value gap is just sitting on its own. So even if price is coming back, we are not even going to be looking at the fair value gap. We are going to be looking at this last candle. And actually, the last candle is this blue candle. You can see it, not even this bullish one. Why? Because this one is higher than this one. This thing is a bit complicated, honestly. And this kind of I'm just like it's advanced. So what you're looking at is that this candle is higher than this one. So this one is actually the other block in this case, honestly, and it's been mitigated. The other block is heavy because so even if you are looking at this as calling me a fair value gap, it's not a valid fair value gap. Why? Because this guy was supposed to be the higher one, and then the next candle following it, and then you see, but this one is not. Is we actually just have two consecutive candles, not three. But I don't know how to explain it. That's where fair value gap issue comes in now because you don't just not every gap you see that's a fair value gap or just a probably valid fair value gap. So this one is you could call it a gap, but it's not valid. So that's why price will most likely ignore it. And even if price is coming back, price is just coming for 50% of this candle because this candle is the candle that actually swept liquidity. So this candle is the funding candle, the one that has the money, not even the fair value gap. So the likeliness of price to come back here is very low. First of all, this guy is not within the zone, so there's no breaker block. The fair value gap here is not valid. So, which is why it will be pointless expecting price to come up to that place. All right. So, and if you understand this one now, that okay, price may not come as well. So, the moment there's a shift here, depending on you and how you trade, but for me, I won't even trade it. The risk is too much. When there's a shift here, you just enter and put your stop loss here, but the risk does not make sense. Okay, but if this was a valid fair value gap with a mitigation block inside, that would have been a sweet setup. So the best setup in this kind of case would have been the 1 hour time frame. So I didn't even see any reason why I want to stress myself going down to the lower time frame when I know that I could easily take this trade here. And gold being gold, honestly, I wouldn't even bother too much. What I would have done is that my stop loss won't even be here because this is gold. Anything that makes gold not to respect this fair value gap at all, because sometimes it will just tap and go. If getting to 50% and doesn't respect it and then closes up to the fair value gap and goes above it, it's pointless most times because for price to really respect other block, there has to be a liquidity. Mm, because other block is a reversal strategy, and every reversal needs liquidity. But fair value gap is a continuation. This is just this is advanced. Fair value gap is a continuation. So continuation strategies don't need liquidity. They just need something to fund the move. The liquidity itself is that fair value gap. But coming back for other block, it will need to engineer liquidity first. And most times, it is the mitigation of fair value gap that creates a liquidity. For example, this is advanced. I know it. For example, let's just say that this place is now the liquidity, all right, because price has respected the fair value gap. Then it would have created the liquidity. Many of you know this kind of structure now. So I've created the liquidity. You can see you call this like this, price like this, then there's a sweep, then there's this drop, break of structure, then there's engineered liquidity, then price goes, then price now comes back to the other block, tap the other block and drop. Have you seen it now? So other block trading is what other block trading is a reversal trading. Fair value gap trading is a continuation trading. So every other block must have liquidity for you to validate it, especially on your lower time frame. In the daily time frame, doesn't really matter because you will always validate it using the hourly time frame. But on the hourly time frame, the intraday time frames, you always validate with liquidity. All right. So you now know the difference between a continuation strategy. We need to engineer liquidity. Sorry, a reversal strategy. We need to engineer a liquidity. A continuation strategy doesn't need that. Price just taps, goes up a little bit and drop. For price to actually do continuation, when you are expecting a continuation, when price begin to go above 50% of a fair value gap, especially when it is wide, I think you should start thinking of getting out of the trade because it will most likely not hold. The other block may most likely not work because that other block has low probability. But if that's the major reason why your stop loss should be around here, not even here, because I mean you are expecting this to hold price. Fair value gap, there's even a breaker block. If these guys can't hold the price, then this entirely is a different kind of setting, right? So that's for that. We've learned something today.